If you've been investing for the last 1 or 2 years, chances are you've heard about Palantir stock a lot. Palantir was on the spotlight in 2022 and 2023 with so many articles like the ones you're seeing on the screen right now. Palantir stock, this dip is a gift. Down 22% from its high. Should you buy the dip on Palantir stock? Well, that's exactly what we are going to find out right now. And just to add on, this company has just confirmed that it has been having a positive net income for 4 consecutive quarters for the first time in history. Of course, it started to become profitable in Q4 of 2022, and since then it has been profitable every single quarter. So we'll be doing a deep dive into Palantir Technologies, the data analytics leader. So in their annual report, Palantir says that they build software that empowers organizations to effectively integrate the data, decisions, and operations at scale. Before we properly start talking about the stock, we should note that 56% of their 2022 revenues came from government agencies all around the world, and 44% came from commercial clients. 61% of their whole revenues came from USA clients, either commercial or government agencies. They work with clients in every single industry you can imagine. For example, the automotive manufacturing industry, the oil and gas industry, pharmaceutical research industry, supply chain management, and even military and defense, which I believe is their most known one. They have 3 main solutions that they provide, and they all have pretty cool names. The first one is called Gotham, and it enables global defense agencies to transform massive amounts of information into an integrated data asset. So this basically means that they convert all the different information that global defense agencies have, they create a software around it, and they make it easier for the global defense agencies to actually locate their data and work with it through analytics, big data research, and all those type of technologies. The second one is called Foundry, which is basically the same kind of system, but geared towards institutions and commercial clients. And the third one is called Apollo, and it is a universal software basically that it can adapt to different settings to make sure the software keeps running smoothly. And you can see that the commercial revenue is growing a lot faster than the government revenue. In fact, almost twice as quickly. And this is great to see because commercial revenue tends to be more diversified, safer than government revenue, and it is a lot better to be less dependent from governments when you're becoming such a big company like Palantir is nowadays. We can see that the commercial revenue growth in the US has actually grown a lot faster than in the global terms, and that their government US revenue growth has been growing at a slower pace than the global. And this is wonderful to see. Why? Because it means that they're doing the effort to be less dependent from the government, especially in the US. Their revenues, gross profit, and net income have all been growing quarter after quarter consistently. And you can see that their net income actually turned positive in the quarter of December 2022. And since then, they have completed 4 consecutive quarters being profitable, which is a huge accomplishment for any type of company. Their net margin has also been growing, and it is sitting right now at close to 15%, which is great for a company that has been profitable for only 4 quarters. This company has almost no liabilities, or at least they're actually keeping this under control very steadily. You can see that their current ratio is close to 6, which means that this company is very low liability. And in terms of debt to equity, their debt to equity is under 0.1. Could they be using more debt to grow faster? Yes, but I fully support their choice of not using a lot of debt because that is the way that a lot of companies actually go bankrupt. So I do like the trend that I'm seeing here. Fundamentally, this company is as solid as you can get them. I give them a solid 7 out of 8. Since it has extremely low liability risks, it has a very solid balance sheet, and it has great insider ownership. 6.4% of the entire company is owned by management and Palantir employees. And this is great to see since you want management to have skin in the game so that they are affected by stock price movements and they attempt to maximize shareholder return. In terms of shares outstanding, this is the only red flag I did see because they are not focusing on buying back shares yet. They are doing quite the opposite. They're actually issuing more shares little by little. There's nothing crazy. But however, you would want this number to stay or solid and stable at the same number or decline. And this company is doing quite the opposite. but they are growing their revenues organically very fast, which is great to see. They are growing their free cash flow organically extremely fast, and they do have a clear competitive advantage and a huge existing moat. I see Palantir as the SpaceX of data analytics, and that is a great comparison to be making because this company, first of all, was one of the first movers into this category, and it already has such a wide customer base filled with quality customers that this itself is considered a huge, wide moat. And of course, they do have pricing power because since they have the brand, the recognition, and the quality of their software that they provide is so high, they have the ability of setting whatever price they want to their customers. This company follows secular trends clearly since it's implementing AI into their softwares. It's using big data and it is all around data analytics, which are three secular trends. They have two main growth avenues the way I see it. The first one is to obtain new clients, which they have been focusing on doing so. Because it's great to see that a lot of the revenues come from repeat clients. However, the best and fastest way to grow your business is to obtain newer clients, especially moving away from government contracts and moving more into commercial companies in the S&P 500 or even bigger companies. And the second growth avenue is earning bigger contracts. Right now, the contracts are relatively small. However, they are doing such a good job and the customer satisfaction is over the roof, which will mean that in the future, they will of course get bigger and bigger contracts. And this is something that we love to see as the investor in the company. Valuing this company is very difficult since they've been profitable for only 4 quarters. It's hard to judge of a PE ratio. However, in 2023, they grew massively and are up almost 150% in the past year. I do believe that this company is trading at a huge premium to what it's generating right now, but this is because of some factors. Firstly, they have unmatched growth rates. There are only 2 or 3 companies growing at their pace. Second of all, they are profitable, they are unleveraged, so they have low liability risk, and they have a great balance sheet. And third of all, they are already producing very, very positive free cash flows. So this company, of course, should be trading at a premium because it's such a good company that everyone will want to own it. This company is really good and I do see a lot of potential in the long term. So if you want to own it, you will have to buy at whatever price you feel comfortable and then dollar cost average whenever you see that this company is actually going down in price. In terms of upcoming catalysts, I do believe that a decrease in interest rates would incentivize this company and would improve their revenues, since a decrease in interest rates would allow firms to increase their growth-focused expenditure, and some of that growth-focused expenditure always goes to data analytics and software. What can go wrong here? Well, that interest rates are not decreased as much as they're expected to be, and this would cause for lower growth rates as companies would decrease expenditures, especially in very interest rate dependent sectors such as the automotive industry, which they work with a lot of clients in there. And second of all is that they would have increased borrowing costs. Even though Palantir is not too leveraged, I just put there in here because there are no other things that could go wrong. But what can go right? If interest rates are decreased as much as they are expected to, then revenues and net income could be increased since companies would spend more on this, and Palantir would have more investment opportunities and the ability to obtain a higher leverage if they wish to do so. Before moving to the investment conclusion, remember, I'm not a financial advisor and this is not financial advice, so make your own due diligence, please. But this company has a great moat, steady growth, which is persistent and steady, and the catalysts, I believe that there is more risk than reward in the catalysts. However, I don't believe that the company will move too much based on this catalyst. So for me, it is a very, very good company, which will for sure be a good investment. However, it trades at a high valuation, so catching it at the low will be very hard. Thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic or Trading 212.